Hi, I'm Darren King with Unbridled Ventures. We're an early stage angel fund that invests everywhere in the United States. And today we're going to talk about key terms that we think every investor and every founder needs to know. So here are four of the terms that every entrepreneur really needs to understand when raising capital for their business. Also, it's very helpful for angel investors to have a firm grasp on these terms as well. And we'll go over all four in this short video: pre-money, post-money, enterprise value, and equity value. Now, most people have heard of pre-money value, and people also talk about equity value, but two terms that aren't frequently discussed are post-money and enterprise value. So let's go over all four. The pre-money value of a business is the equity value before a round of capital is injected into the business. Post-money is the equity value of the business after a round of capital has been injected into the business. Enterprise value, which is a term rarely used, is the total value of the business. So, for example, if you sold your business for 10 times EBITDA, and if the business was generating $1 million in EBITDA, we would say the value of that business, the enterprise value, is 10 million. The equity value of the business is the enterprise value less any debt associated with the business. So back to that example, if your business is worth $10 million on an enterprise value basis, and you had $2 million worth of debt, the equity value would be 8 million. So if you sold the business for 10, enterprise value, you have to pay off the 2 million in debt. Your shareholders would receive $8 million, not 10. Let's go through a few examples. So if a company was raising $1 million at a $4 million pre-money valuation, and sometimes we abbreviate this in the venture capital world to say raising one at 4. In this example, the pre-money value of $4 million, $1 million was raised. So the post-money value is 5 million. Essentially, we're saying right before the investor put money in the business is worth 4. So the investor put in $1 million. So right after the cash infusion, the business is worth 5. So the existing shareholders would take dilution of 20%, which is the amount raised divided by the post-money value. So the pre-money and the amount raised helps determine the amount of dilution that the existing shareholders will take with the capital round. Another example, let's assume the company was raising 2 million at 4 pre. In that case, the dilution would be 33%. One thing to keep in mind, post-money determines the investor's break-even equity value. If a company is raising money at 4 and I put in 2, in order for me to break even on my investment, the company needs to sell for an equity value of at least 6 million. So some people think if a company is raising $1 million and they double their investment to 2 million, that the dilution will be twice as high, and that's not the case. So one way to look at it in this example, the first example, the company is raising $1 million. The second is raising 2. For the first $1 million, essentially, if they stopped at $1 million, it costs 20% of the company. But for the second $1 million, it costs 13%. So it's not double, it's not 20%, 20%. It's 20%, 13%. And that's just because of the math. It's 2 divided by 6 in this case, and then 1 divided by 5. So that's something to keep in mind. A lot of times, entrepreneurs who are in desperate need of additional capital for their business refrain from taking on additional capital because I think the dilution will be a lot higher. A few more examples to explain enterprise value. And keep in mind the enterprise value and the equity value are the same when there's no debt on the books. And that's what we're showing in example 3. The enterprise value is $4 million. There's no debt. The equity value is $4 million. So if the company is raising money at a $4 million pre, $4 million, it's the same as the example we just showed. And in this case, the post money is 5. So that's the investor break even point. The company needs to sell at an equity value of 5 million or more in order for the new shareholders to break even on their investment. Another example with debt on the book. So let's assume that the company is raising $1 million at a $4 million pre and has $2 million of debt on the balance sheet. In that case, the enterprise value is $6 million. Okay, so in these two different examples, the only difference is the debt. In the first example, we're saying that the business was worth 4. In this example, it's 6. So a company that has debt on the books and equity would have a higher enterprise value, assuming the pre-money equity value is the same. And this is often overlooked by angel investors. You have to consider the entire capital stack when you're making an investment, because all investors will need to be paid back and all debt holders will need to be paid back. So in this example, raising $1 million at 4 with $2 million of debt, the break even for the investors is $7 million, not 5, because the $2 million of debt will need to be paid back when the company sells. So this is another reason why angel investors need to ask to see a balance sheet when they're looking at putting money into a company to see what the net debt is. When we say net debt, we mean cash less debt. One more example, company raising $5 million at a $10 million pre with $10 million of debt on the balance sheet. In this example, the enterprise value would be $20 million. Subtracting the 10 of debt would have a $10 million pre-money equity value. If the raise were 5, the post-money equity value would be 15. But the investors' post-money enterprise value break-even point would be 25 million. And angels often overlook, as we said earlier, the debt associated with the business. And they assume that their gain or loss is based on the pre-money equity value at which they participated. And that's not the case. It's really your post-money value that you have to consider. And if there's debt on the books, it's the post-money equity value plus the debt. So in this example, note that if a company was raising money at $10 million pre, and the investor bought in at that level, selling at a $20 million enterprise value, selling the whole business for $20 million, when there's $10 million of debt on the books, would be a loss for the investors. Some investors will look at this example and say, well, I put money at a $10 million pre and they sold it for $20 million. I doubled my money. That's not the case, because all equity investors and all debt holders have to be paid back as well. That concludes this video. Hope you enjoyed it. If we can help you in any way, if we can answer any questions, or if you're in the need for capital for your business, please reach out to us at unbridled.vc/contact. Thank you.